Welcome back, everybody, to What Are We Missing? I'm Garrett Baldwin, and this is the show that we treat the financial world with the reverence and the respect that it deserves, which is none. This is our sixth show, and usually I would be doing something that is a little bit of a nerd fest. We would talk a little bit about how the financial industry is unique and walk you through what's happening with the financial markets. But look, I'm not going to do any of that today. I'm actually just going to kind of lean back and just talk, because it was a while ago that I did a video, and it was Jerome Powell edition of the Monopoly game. And I basically explained what the American world, what the economy would look like if we all started a game of Monopoly simply where we are today, simply on the start, and who started with what pieces and how quickly the game would be over. And it was about 50 minutes long, and I liked that because it just allowed me to talk and rant a little bit about the state of affairs. So my show today isn't going to be another nerd fest where I start discussing the mathematics of collateral elasticity, and then like three people sit here and they question all of the decisions that they've made that have gotten them to this point. The math is all still there. The repo facilities are still here because it's very clear that I have offended God in a very specific way. So today, this is going to be a completely different show, and we're going to start there. This is episode 6 of What Are We Missing with Garrett Baldwin, and you know who I am. I am the editor of Postcards from the Edge of the World. I am the editor of Me and the Money Printer, economist, statistician, and overall increasing cynic. And one of the things that's kind of happened in the last couple of weeks is, as we'll discuss, is they rewired the whole financial system again, just in case you didn't need to know that they had did it the first time back in 2008 and then kind of again in 2020. And well, they're doing it again, and it's all really going into effect this week. And we're going to talk about that. And as we look at this, again, they rewired it while I was explaining that they rewired it the last time. So this show is just going to be described as what I will say a temporary deterioration in presentational stability, to use kind of the vernacular of Wall Street, that great, wonderful place that inspires all of us to invest our money for the long term. These markets make so much sense, don't they? So why don't we have a nice Saturday conversation about how great the markets are and all the participants involved in the rewiring of the system and the people that you come to get to know by doing this with your time. You're going to love it. And the problem for me is no longer that I don't understand any of this. The problem is increasingly that I probably now know too much, and that's an issue for me. It is a problem because I understand the Treasury market plumbing. I understand hedge fund leverage and central clearing and tokenized collateral and facilities standing behind all of the things. It's gotten so bad that I would probably consider myself socially dangerous. My wife says you can't talk about these things. And if I don't say this into YouTube, I'm going to corner some poor guy at the community pool, and he's going to be applying sunscreen, and I'm going to explain the Treasury basis trade directly at his face until the security comes and gets rid of one of us. And this guy just came to the pool with a foam noodle, and it's not even a full foam noodle. He's just there, and he's got a family, and he's trying to drink by himself. He got there early. They opened the bar at 11. He's having a Long Island iced tea, which is very questionable around a pool full of children, but it's his day away from his family. So it's very important that I don't sit there and try to explain sponsored clearing to him. So this is the only socially responsible option that I have, is to just say all of the things that I'm about to say out into the abyss. That's what this is. This is no longer a presentation. This is a controlled release. So do me a favor, close the door to your, wherever you are. Just close the door. Pour a drink into a glass. I don't care what it is. Tell your family that you're watching a documentary about the electrical grid. Nobody's ever interrupted anyone in recorded American history when they say that they're watching a documentary about the electricity grid. That'll be fine. You could be discovered face first in your desk, nose bleeding after 6 days, and you're there and you're reading a Federal Reserve H1 document, and your wife will tell your children, you need to leave your father alone. He is trying to maintain his financial credentials for his Series 65 or his CFA. I have spent the last 8 months in essay after increasingly insane, desperate essay trying to explain to everybody how the central banks have quietly rewired the entire financial system since 2008, after the dash for cash in 2020. 8 months ago, I lost Christmas. I lost Christmas to the Bank of Japan and the standing repo facility. I lost 4th of July to sovereign collateral and deep concerns once again around private credit and what's happening with the Federal Reserve and the new plumbing that is being pitched by the Bank for International Settlements that most people don't even know what that is. And we're going to talk about it today. My daughter had asked me during Father's Day, Dad, what do you want? And I said, I want a clean way to explain sponsored clearing to people. So she made me a card, and it had a dog on it, and it was really nice. And I want to say for the record, that dog understood sponsored clearing probably better than 90% of the financial press. And we've gotten to the point of this show, of this Substack, of everything that comes with it, that my wife probably now thinks that I have another family in Basel, Switzerland, a quiet Swiss woman named Ingrid, 2 very pale children, a modest-looking apartment overlooking the Rhine, and every Wednesday, Ingrid she makes fondue, and we talk about the Swiss national soccer team, and that's great. And I try to explain the fiscal financial stability nexus to a very small, serious boy named Klaus. And when I'm doing that, Klaus says, Papa, will you come and watch my football match? And I say, no, Klaus. The FICC has just accepted another sponsored member. It's called BlackRock. When you're 10, I will explain how BlackRock controls this country and this continent and virtually everything that we touch. And Klaus just nods because Klaus is Swiss, and he knows that his father is a very serious man doing extremely, very, 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 very serious work. So what has happened? While I've been doing all of this for, I don't even know how long this has been going on. This had to have been at least since September when I started having a little bit more free time. I was trying to explain the reserve management, the program that the Federal Reserve just goes, it's not quantitative easing, everybody. Don't worry. We're not doing quantitative easing. Okay, well, are you printing money? Yes. Are you buying treasuries? Yes. How is that not quantitative easing? It's just not. It's not, they say. Oh, okay. All right. So you're buying treasury bills, but not longer term bills. Okay, we get that. So it's not QE. It's not stimulus. What is it? It's management. It's management. Yes, it's management. Oh, okay. But hold on. Are you trying to achieve the exact same outcomes of quantitative easing? Yes. Okay, that's all that matters. No, don't call it quantitative easing. Does it ease financial conditions? 100%. Okay, so you're printing money and you're pumping it into the economy and financial conditions are increasing. How is that not stimulus? It's not. It's liquidity management. But that's the same thing. Don't say that. But it's the same thing. No, don't say that. But it's this. And then I try to explain sovereign collateral. And then I try to explain non-bank leverage, right? Hedge funds, private credit. And then the BIS report, which was written on June 28th. And I went through that whole thing, and it's written in a tone that a hostage negotiator would be forbidden from using the word hostage. And these people, these fucking people, rebuilt the entire financial system on top of the last rebuild, which was only a couple of years ago. And they didn't even wait for me to finish the PowerPoint, and they didn't wait for me to send an update to my audience. And no one from the Federal Reserve called and said, hey, Garrett, are you close to finishing that standing repo facility article? Because we just bolt tokenized settlement agreement onto the sovereign debt market. And we invited Larry Fink from BlackRock, Solomon from Goldman, JP Morgan and Circle, and the DTCC, and more than 50 banks, more than just 50 banks that are all here. And they have a bonus pool that could run and pay for Baltimore County until the sun burned out the whole earth. And they just did it. They just did it. They didn't tell anybody. They don't tell anybody. So they didn't do it. The memo doesn't go out. Nobody consulted you. Nobody held a town hall. Nobody mailed a survey to your house. They don't even know where you live. Nobody's asking you questions about, hey, let's do a phone survey where we ask people, how comfortable are you rebuilding the entire U.S. government debt structure around a highly leveraged hedge fund trade that is routed through clearinghouses that can't ever be allowed to fail? Are you very comfortable? Somewhat comfortable? Not called comfortable? And then there's another box, and it just says, I rent and I have given up on all of this. The memo didn't go out because the memo never goes out. And so, you know, this whole conversation today, I just wrote down 40 sentences that I just wanted to riff around. That's it. I'm just freaking going with it because I've reached this point now where it has gotten so absurd, and you saw the market this week. People are looking at the market and they're saying, how is the bond market holding up? How is the S&P 500 sitting near all-time highs, even though the market completely shrugged off? It shrugged off the fact that we have escalated the war again. The Forex volatility is at 6-year lows. How is that possible? You're seeing it. It's the money printer that we talk about. And I've gotten to the point where my tone is going to start to change a little bit because I can't sit here anymore and just go, okay, guys, let me try to explain to you very simply that there is a nice little waterfall effect between liquidity and momentum and mechanical buying and insider buying and public policy. And these mechanisms are very important for us to understand overall that in the financial system, economics has broadly changed since 2008. No, it has gotten to this point where it's so absurd. Everyone needs to recognize, look at the fact, I have an MBA. I've read enough of the CFA to understand it. I helped do a lot of Kaya research and also help build some educational materials around that. I get it, okay? I went to grad school for all of this. I get it. And all of the things that we were taught, hey, think like Warren Buffett, right? Think like Warren Buffett. Go out and buy a company and ask what it's worth. And today, as I explained over the last couple of months, it's no longer about that. It's about whether or not a prospectus says you have to buy, whether or not that leveraged ETF or that CTA or that other group, they have to buy. That's the game now. Passive flows, 52% after 2025. Well, we're going back to 2010 when it was 19%. And I can't sit here on like after spending a week, right? I spend a week, I do a lot of very nice analysis. I take everybody through it, and I like doing that. But at the end of the week, I have to scream into very tiny jars. And I don't want to go spend the day at a bar. I want to sit here. I want to go play with my kid. I want to go to a pool. So I'm just going to just talk. And if you want to listen to it, God bless you. Because I'm going to get this out of my system, and I hope that you will be, one, entertained, and secondly, you're going to walk away and go, holy shit, this is what's going on? Yes, It's not that complicated because our system is changed in rooms where they serve stainless steel carafes of coffee, and these people have to effectively sign a non-disparagement agreement and a non-disclosure agreement that they were ever there. And they basically say, we will not discuss what has happened outside the meeting. And that's all well and good. And then 3 months later, you're going to see like 250 words from the Financial Times. And it's going to say something like, the Treasury market modernization gathers pace. And whatever somebody says the word modernization, I want you to make sure that your wallet is still attached to your soul, okay? Because that word is bananas. We're going to start this week with a quick tease on what we're going to be talking about because I wrote about it yesterday, and I want to give a little bit of credit to Glenn Handley. Glenn Handley writes a Substack. It's called The Desk, which I assume is shorthand for Repo Desk. He spent 30 years in repo, collateral, and I've been writing about it for like 6 years. So I'm going to assume that if I ever meet this man, I'm going to feel a lot like Andy Dufresne and Tim Robbins walking into Shawshank Prison, and there is Glenn. He is Morgan Freeman. He has been there a while. He has seen things that only a handful of people have ever said. He is a man who understands how to get things. And in this case, it's getting information about what's actually going on in the financial system itself. So earlier this week, he lays out 6 separate developments that hit the Treasury and the repo markets all at the same time in a 7-day window, all conveniently happening while we are negotiating with Iran and we are all watching the World Cup. Because what better time to rewire the financial system than when everyone is watching the World Cup? So go read him. He did the homework. He did the field work. He has very good knowledge of where the bodies are. And I'm the guy who arrives 40 minutes later. I put on sunglasses. I point at 17 shell companies and I say, this is somehow going to end with Larry Fink making an absolute cartoonish amount of money. And it will, because it always does. And that's the whole thesis. They have been telling you, I've been telling you for 8 months, and now it's happening basically on a Sunday. So Handley found the clearinghouse. I found the people who actually need it. And they're going on television right now telling an orthodontist in Scottsdale to go buy NVIDIA. We have to go there first because this really isn't about liquidity. Liquidity is a scented candle version of the story. It is permission in the global financial system. It is the word that they use when a trade has eaten up part of a building like a monster, but the man in the quarter zip is still allowed to chair the morning meeting. And that's very important. They are preserving the marginal buyer. The dealer is financing that buyer, and the analyst is explaining why that buyer wasn't wrong. The television guest is just finding a fresh orthodontist somewhere to buy what the buyer just sold. And they're preserving a man named Doug's boat. And we're going to talk about all of this. They are preserving the sacred right of every financial institution involved to wake up tomorrow morning, put on the same badge, open the same stainless steel coffee shell, and continue speaking with authority after the machine that they built nearly killed everybody multiple times going back to 2008. And remember one important thing: a client can lose money. A client on Wall Street can lose money. The institution can't lose a meeting. So somewhere in Manhattan, a man who sold a stock on Monday is putting on a brand new vest, and he is going to explain why you should buy it on Wednesday. And that is where central clearing begins. Let's talk about artificial intelligence, because that is exactly what this market really needs. But we're going to start with, in this conversation about AI, to acknowledge what a beautiful and elegant institution the American financial market really is. It is a sanctuary. It is a garden. It is a place where ordinary families can place their retirement savings and immediately find themselves surrounded by 14 intermediaries that charge 12 fees while congratulating one another on democratizing finance. We are running the greatest casino in the history of anything. And the real casino, this is the irony of it all. A real casino treats you way better. At the Bellagio, they will give you drinks. They will pump oxygen into that room. They will ask you how your day is. Your dealer will talk to you, and they will say to you, oh, you're from Jacksonville. That's fantastic. I once dated a girl from there. Yes, she was crazy. Yes, most of those girls from Jacksonville are. Oh, you want to hit on 16? I don't advise that. I'm showing a 5. They will tell you up front, hey, the odds are better if you don't do something. At the Win, they might even remember your name. At the New York Stock Exchange, you get a 1099. You get a reminder that past performance does not guarantee future results. At a real casino, you could see it. The odds are put on the table. They put it right in front of you. The dealer cannot lie about this. And if he even thinks about lying about any of this, the Nevada Gaming Control will come to him, remove him from the property, and this man will be selling certified pre-owned Nissans in Henderson, Nevada within the next week and a half. It is a lock. In finance, it is the total opposite. The house edge is on page 82 of a prospectus that you could barely see on a screen, and it's written and translated in a dialect that only compliance officers and dead people in Brazil can actually understand. The fund charges a fee. The platform charges a fee. The custodian charges a fee. Who else does? Your advisor. And then another company charges you to prepare a statement listing the fees in a font that was designed for an owl. Now, this is Doug. All right. I want you to meet Doug because Doug is your advisor. Doug went to Villanova. He probably studied communications. They got a pretty good communication school. He wears Peter Millar quarter zips, and he does it over an Oxford collar to tell you a couple of things. First, he wants you to know that he follows capital markets, and that's very clear from the fact that he is doing very well. He's wearing the quarter zip. He looks great. He doesn't look like he has combed his hair or cut it in a while. And based on his complexion, he has been drinking for 2 to 3 days. But that is okay. And he's wearing that outfit because that screams, I have a subscription or did have a subscription to Modern Trader magazine at one point, and I read Garrett Baldwin. In addition to this, I have CNBC on in my office, but the audio is off. It's got to be off. If you go into an office and CNBC is on and the audio is on, run away from that place. Run away from that place. It's literally just artwork. That's the whole point of it. And every now and then people will walk by and go, oh, gold's up 3% today. Oh, what happened to Palantir? That's really what it is. It's kind of like a piece of artwork, and everybody walks by and they go, oh, I've really never looked at this piece of art from this angle before. Well, no, the reality is CNBC on a flat screen on a wall is basically a reprint of Pollock, and it's just there, and people are talking, and it's great, and it's in the office, and you never hear anything, but you do see the Cryon on the bottom. And every now and then you'll see one of your stocks, and then you'll see that Berkshire Hathaway is like $737,000 per share. And you'll say to yourself, wow, I would really wished I would have bought that in, say, like 1985 when it was at $10,000. And you don't do that because, again, you're just there. And Doug's got other things to do. And that's one of the reasons why he's wearing the quarter zip is he's also telling you that he may directly leave this meeting to go to a clam bake and drink about a half a bottle Woodford Reserve. So Doug will put you into a low-cost index fund, and he will charge 1% of your money to select that, okay? He is going to select a fund. You're going to pay him 1% of your money. Now, he did not create that fund. He does not even manage that fund. He clicked on that fund because Doug owns a boat, and his boat is called Long-Term Perspective, okay? It is not a yacht. Doug does not have yacht money. He is a RIA, and he's been around for a long time, and you're one of like 12 clients. He has marina money. He walks down a communal pier carrying a soft cooler that he got at Costco. It is Kirkland Brands, obviously. And he resents the guy with the private dock with an absolute spiritual level of disdain. And at the annual review that you will have with Doug, he will swivel a pie chart at you and he will say, listen, we remain cautiously optimistic. And he will then move 2% of your money from institutional developed markets into domestic value. And he will use a word like ballast to describe that decision. And you will shake his hand and he will go home and he will order a fish finder, and it's going to have side scanning sonar, and it's going to cost probably like $3,800. And the reality is, Doug has never caught a fish, but Doug has a boat, and you bought that boat. And because you bought that boat, because you felt really, really awkward ever asking why your portfolio has 9 different funds that own Microsoft in it. Once again, at that casino, when you start to unravel, they do nice things for you. Somebody cuts you off. Our casino, the casino that we live in, we send you confetti. So if you're in the bathroom at 11:48 one night and you are clicking on your phone and there is a leveraged ETF, single stock ETF, you can buy that on a Tuesday, and your phone will throw confetti at you from Robinhood. They will celebrate you buying a triple levered ETF tied to semiconductor stocks as if you have somehow completed a bar mitzvah, graduated from high school, turned 25, and you can finally rent a car, or made it to 100 where it should be allowed that you can commit a serious crime. To borrow, I believe that's a Louis C.K. bit, right? You can commit crimes at 100. You would get confetti if you did that. But here's the thing. When it comes to options trading, we barely care if you have any emotional attachment or understanding or knowledge of it. Literally, you just have to say, hey, would you like options approval? Do you understand derivatives? And you can say emotionally, sure, I've been divorced twice. What is your investment objective? Well, I want my brother-in-law to stop laughing at me at Thanksgivings. Okay, revenge. That's fine. You're approved. So now you click a button and the confetti falls, and you get a digital balloon, and that's financial inclusion. That's innovation in America today. That is all of the people who could have been building bridges and roads and buildings and making sure that our rockets continued to do great. They didn't do that. They went in and they designed leveraged ETFs and other types of things that pay a fee no matter what happens. And if something happens to the road, yeah, they get in trouble. But if NVIDIA falls 40% in 2 weeks and the leveraged ETF blows up, that was in the prospectus. That was on 82 the entire time. You didn't read it. That's your fault. You get an email. Thank you for your money. So you now own a daily reset leverage on a semiconductor company whose annual report you probably have never opened. And the other thing to keep in mind is that on top of this, the entire thing, which is even crazier, is that unlike a real casino, this casino has a partner. And that partner is the Federal Reserve. Okay, so imagine that the Bellagio is just operating normally and the whales upstairs start losing money. So the United States government just comes in and they just arrive through a service elevator and they restock all the chips and they stabilize the tables and they push everybody out there in order to preserve the gaming floor functioning. The public is not at the high limit table. The public is near the parking garage playing nickel slots under a flickering light. And this is where finance gets weird. This is the entire point of all of this. It gets really strange. The public is still responsible for maintaining confidence in this resort. And all of this is happening at a time that the AI trade is completely and totally getting out of hand. So one casino will actually tell you the rules. They will give you booze. They will tell you, listen, you've had too much. You need to go home. You need to go talk to your family. You need to stop doing this. You also, if you win, they give you things. They'll comp you a room and they'll say, hey, why don't you come back? Because they know that over time the odds are stacked against you. But at least they're honest about it. But on the market side, it's now just gotten to the point. It's like we're going to try to extract and take whatever we possibly can at any given moment. And the reality is now this market has completely and totally lost its mind, and momentum is completely and totally warped right now because of what has happened on every trading floor going back to March, but really we can go back to last year. So the Federal Reserve is pumping money into the system. And at the same time, for 6 months, every single guy on television, every strategist at every bank, every one of those fund managers who goes on to television and they've got one of those Zoom, they've got a Peloton in the back and they're doing a Zoom call and the compliance department is reaching out to make sure that they know that the separation is going well. Every one of them told you the same 4 words for 6 months. It's all about AI. The robots love us. Just plug our damn economy into the wall. It'll be great. We're all going to become gods of just incredible intelligence, and it's all going to be tied, thankfully, to these language models that still we don't even know if people are going to buy. But okay, but the hedge funds, they went all in. It became one of the most crowded trades in the history of markets, and they weren't diversified in any way. And they weren't running any proprietary research. They were all just really largely in a Discord together. You had 40,000 professionals with the same 9 tickers, eating the same dry-aged ribeye, going to the same restaurant in New York and telling the same waitress the same joke about margin calls. And a very expensive portion of this ultimately ended up in a situation where we had a crowded trade into the same handful of names while the companies underneath them funded the build out with take or pay contracts, with long-term leases, with special purpose vehicles, with Delaware entities that are held largely together on good faith, some form of bizarre legal drafting, and an assumption that demand will arrive before the depreciation schedule does. And this week, every American was staring at the Federal Reserve minutes like it was a total eclipse over Nashville, and these same funds quietly began dumping the trade. And the funny thing about this, institutions don't dump trades. They recalibrate, they normalize, they reduce concentration. They will throw the fucking couch through the front window of the house and tell the neighbors that they're opening up the room. And then the next day it'll be on Redfin and it'll be listed as an open concept, and the landlord will have raised the rent, and somehow BlackRock will actually own the building. The index has now recovered just enough to make this crime scene look orderly. And that's the funny thing about all of this, because at the end of the day, right, 70% of the technology stocks of the S&P 500 were still at least 20% below their 52-week highs this week. The lobby is calm because all the screaming has moved into the individual rooms. Volatility on the individual stock compared to the volatility, right? The vol EQ, the VIX EQ is at a record spread to volatility. It is insane looking. It is absolutely insane looking. Single stock volatility. We have never seen this before. And the same time, we're looking at a name like Oracle, which just got absolutely beaten up, taken out outside of the warehouse and basically beaten senseless, down 40% over a month. And when I looked at the screen, a company of Oracle size falling like that, that is not a correction. That is a bank robbery in broad daylight with the security guard eating pineapple pizza on a lunch break. This AI build-out was generating enormous amounts of debt issuance, a long-term, these long-term leases, purchase commitments, massive power contracts once again. And the thing about it that's just like so completely and totally insane is that when you look at the reports that are coming out of Wall Street, it's very simple, right? It's hedge funds aggressively cut AI-linked longs. Okay, well, again, why? Huge debt issuance, long-term leases, power commitments, power contracts, obligations that don't fit inside a clean debt number. Even NVIDIA, a company that could fund most small European nations from their couch cushions, just sold $25 billion of bonds. Not because they're broke. NVIDIA isn't standing outside of a plasma center asking what time the direct deposit hits. The richest man at the table suddenly borrows $25 billion. You stop chewing and you ask who's financing that dinner. And what we're seeing, like, this is like Warren Buffett walking into a payday lender beside a Panda Express, not because he needs the money, but because Kyle behind him has somehow offered 40-year financing at 6%. The exact desks that spent 6 months selling you AI as the only investable theme in world history are now publishing internal notes titled "Time to Buy the Dip." Of course they are, because this is the entire game. This is the game. A Wall Street bank says hedge funds aggressively cut AI longs that generated most of their gains this year. The exact same bank says leverage has been dragged toward the floor. And then the same bank says data center positioning has been cleaned out. Then, okay, before the bodies have even cooled, the same research complex that turns around and it says the washout looks attractive and investors may want to begin adding risk again. And maybe they're right. And that's what makes this more interesting than cheap cynicism. They may be completely right. The trade may have washed out and earnings may come in strong and capital spending may continue and the stocks might rally 40%. And a guy named Smitherson, who you're going to meet in a minute, may upgrade from marina money to private dock money by Labor Day. But I want to stop for 1 second and I want to ask a question nobody seems to be willing to ask because everybody is too busy highlighting page 6 of some desk note. And I mean this sincerely. What in the hell is the point of all of this sell-side analysis? What is it? Because I legitimately pay an obscene amount of money for financial information. I pay for bank research. I pay for strategy portals. I go to specialist sales notes. I read morning calls. I look for prime brokerage updates. I look for PDFs with file names that look like exhibits that were submitted to the O.J. Simpson trial. And I read some of this stuff and I see every morning I try to read as much as I possibly can. Tactical rotation within a structurally supportive regime. Okay, 3 screens. One of them says that, trying to determine, I don't know, whether a semiconductor stock is a downturn, is a cyclical reset or not, or a factor unwind, or a short gamma event, or a 40,000 people maybe just coming together and saying that they own the same fucking stock. And somebody just had to write all of this. I don't get it. But the reality is this. There is an army of analysts across Manhattan. They're in London. They're in Hong Kong. They're maybe in Chicago. And they're waking up before dawn. And they have to explain yesterday's move. And they have to explain the following things. They have to say that the move was unexpected, that it was tactically orderly, that it was broadly consistent with the House view, and that it likely creates selective opportunities. It has to do those four things, okay? Unexpected, orderly, consistent with the bank's view, and creates selective opportunities. You do those four things. You just write about those four things, and boom, you are a sell-side analyst. You are making good money. And again, you will come to find that these people are not stupid. They are terrifyingly intelligent, and that is why all of this is so dark to me. All of that intelligence has to produce a document every single day that tells a client, here's what happened. It informs them. It calms them down. And it preserves the prior call that they made like 2 days ago. And then it avoids embarrassing the sales desk. And it contains enough caveats that 6 months from now, in 6 months, they'll be able to say that they could prove that they said what is happening happened. They can lay out every scenario possible. They can say that the sun burned out the earth. They can say that climate change led all of us into a dark ice age. They can say that we had discovered a new way to create enough energy to power the sun itself and save the earth. In all of those low statistical probability events, they are still going to be able to say that they hinted in one report in the last 6 months of the possibility and probability of that, and therefore you should continue to work with our buy side, with our sales desk to ensure that you are consistently abreast of new ideas that can bring about profitable opportunities for you and your institution in the future. And the reality is, like, they can legitimately say that this was a rotation and a sell-off and a buying opportunity and a cataclysmic liquidity event all in the same time. And the reality is this, right? The reality is every day these people get up, and I'm going to talk about this in a moment, but every day they get up and they start with their managing director sending them text, and they say, hey, what are your thoughts on X? And then they have to explain the collapse in the AI thing. And then sales calls and says they want 3 bullet points for when they get on their calls. And then Steve Smitherson, who you'll meet in a minute, he has to go on TV. By 9:45, the note is wrong. It's wrong. So they write a follow-up note at noon. And this is the exact purpose of all of this. This is not research. This is industrial production of deniable probability, right? Plausible deniability. Okay? The reality is the analyst doesn't merely need to be right. The analyst needs to be wrong correctly. It needs to be wrong correctly. Because capital can blow up. A narrative cannot. That is the hierarchy. A client's money can just disappear from the face of the earth. And they could call over and over again and say, look, you just lost me a lot of money. You lost me a lot of money. But the institution's authority has to be at that morning meeting every day. A position can drop 18%, but the framework that the analyst provides has to remain structurally intact. The analyst must be wrong. This is important. The analyst has to be wrong with historical context, with valuation support, with a bull case, with a bear case, 3 sensitivity tables, and a final paragraph that explains that risks remain two-sided. A normal person, a normal human being will just simply say, listen, I am wrong, okay? A sell-side analyst will say the timing and magnitude of the normalization exceeded our initial assumptions, although the structural thesis remains intact. That sentence has saved more careers than talent. And if you can memorize that, this is legitimately like, this is becoming like a liar's poker session. A lot of people read liar's poker and they're like, oh, this was supposed to be a warning about Wall Street. In fact, now I find that I actually find this very entertaining and engaging. I want to run to that fire. Well, once again, you need to learn how to just be wrong correctly. That's very important. You need to just remember that you have to make sure that you are informing a client and soothing a client and preserving the previous call and not embarrassing the sales desk and making sure that you provide enough content over enough documents over 6 months that you can prove that you actually said whatever happens will happen. Plus, what's very important is you have to make sure that you maintain the institutional authority at all time. That logo is way more important than you are, and it has been here for 147 years. Did you not know that? There have been great titans who came before you, and you are now at this desk, and you are covering mid-cap utilities that may or may not touch anything in the broader AI trade. And if you are lucky, maybe we will allow you to go sit at a table with the NVIDIA analyst in the future. That's kind of where you start, and then you work your way up, and you just keep building it, and you recognize historical context is what matters. Valuation is what matters. Do I have a bull case for this $5 billion company that no one has ever heard of? What is the bear case for this thing? What type of sensitivity models am I operating in? What can I tell the sales team if they have to get this piece of shit off of our books? And I can help do that by providing an interesting case that otherwise other people may not have thought of. And if it does fall 18%, we're just going to go, well, I mean, look, we laid out in the point that there was a bear case, that the sun may explode, and it did. And we didn't think at all about, like the important macro stuff, like, hey, maybe the Fed's going to raise interest rates, or maybe the Bank of Japan's going to do something that nobody thought of, or maybe we're going to bomb Iran again, and that could drastically increase interest rates, and that's going to weigh on that shitty utility company. But we laid that out in another desk's research. And did you read that? Because it's important that you read all of our research, and we have a full suite of research that you can get access to based on your AUM and how much money you give us to manage. So once again, this is the whole world. And remember that one sentence that I said: never say you're wrong. Never say you're wrong. Say the timing and the size of this sell-off and this normalization was bigger than our initial expectations or our assumptions, but the structural thesis remains intact. The research does not merely try to prevent loss. It prevents the loss from attaching itself to anybody important. It cannot reach the managing director. It cannot reach the sales desk. It can't reach the logo of the bank. The bank has been there for 147 years. It's got 4 names to it. They dropped 2 of them because they thought that they were smart enough to go start their own bank, but now that bank went under in 2008, and these are the only 2 names left, and this bank has endured because we don't ever take shots at the logo. It's okay if our client loses money. The client can lose money. The institution cannot lose the meeting. The institution receives a lesson. And by page 6, the losses belong to the positioning, not to the idea itself. And by page 11, you can blame things like seasonality. And by page 17, you can say there was an unexpected change in a realized volatility regime. Who gives a shit? Institutions convert air into climate. That's right? The analyst must be wrong correctly, but institutions convert air into climate. The bank never misses a trade. It never misses a trade. A cold front just moved through semiconductors. The institution gets continuity. The client gets volatility. The capital might disappear and go up in smoke, but the narrative survives. Maybe artificial intelligence writes some of these notes now. Maybe Claude is doing this. Maybe it's ChatGPT. Maybe they figured out a way to fire Manus up each morning, and Manus is now doing it for Meta because they're like, we don't really like Claude because it actually keeps seizing and it's kind of a mess. But the reality is, I doubt that's actually happening, because artificial intelligence doesn't understand self-preservation to actually work and operate inside of a global bank. Claude will get something wrong. And Claude, you can curse at it. You can scream at it. You could say, you stupid machine. I keep telling you over and over again to stop using had not. I want HADN apostrophe T. I want contractions in my words. Stop writing did not. Stop writing cannot. Don't do that. And you can curse and you can scream at it and you can degrade it in so many different ways. And it will say to you, I'm so sorry. You have every right to be frustrated with me. But the reality is, at a bank, that's not going to happen. That's never going to happen. It will never happen. You will never get somebody say that they are sorry, because if an analyst at a major bank wrote that after blowing a sector call and they said, I'm so sorry about what I wrote, they would be tending bar by Friday on a permanently moored ship in the East River of Manhattan. And it wouldn't be a yacht. It would be a ship that hasn't moved since the Bloomberg administration. And this is a person who would have to pour like warm Pinot Grigio to moms from Stanford who are down there for the day and they're going to see a show. They were going to go see Wicked, but they've already seen Wicked like 4 times. And they were going to go see that thing with George Clooney, but that was sold out. So now they're settled on The Lion King. But before they go see The Lion King, they just wanted to come down and have a couple of drinks. And now they're here, and the frying pan, I don't know, something like that. And they're there, and they're pouring plastic wine, cups into plastic wine for these people, and they're very mean people. They're just not nice to this bartender. And they say, well, what did you do? And he said, well, I used to work at this bank. I used to cover mid-cap utility stocks. And they said, well, what happened to you? What happened? And he has to describe his termination as an unanticipated shift in internal capital allocation. That's the discipline of all of this. The note in a forecast is a defense brief, right? It's not, it's a sales aid. It's a small bunker for paper that an analyst can crawl into when the market begins firing artillery at them. And the reality is, it's the same thing. I pay to read all of this stuff before breakfast. So when I look and I see that funds are aggressively selling AI positions that produced much of this year, they're cutting their leverage, they're emerging with manageable damage. Great. The building lost 2 floors, but the insured artwork is still there. And that flat screen television with CNBC is still somehow playing. And they're interviewing somebody from Palantir, and they're talking to the Tesla analysts from Arc Innovation, who, no matter what is wrong with Tesla, the Arc Innovation person will just talk ad nauseum about AI taxis and basically say that Tesla doesn't have a price target anymore. It's just going to the sun. The same research complex says the clean out may create opportunities to buy data centers and hyperscalers. And maybe it does. Maybe it does. I don't know. I don't think anybody knows. Because once again, this stuff is not written with the sincerity of like, we would use this to begin adding risk in data centers and hyperscalers. Okay. But what is the view? What is the view in all of this? That is the great question that I have for half of this research. What is the actual view that we are seeing? Because when I look at something like this and I read this and I go, okay, look, funds aggressively cut AI linked longs this week. Leverage has dragged toward the low end of the recent edge. We would use this washout to begin adding risk in data centers and hyperscalers. What is the view? The hardware is structurally over-earning. Capital spending is excessive. The largest buyers haven't changed their behavior. Hedge funds just cut positions that made their year. They're beating the S&P 500. They don't have to do anything for the rest of the year, and they're getting their bonuses. Leverage is down. Volatility is low. In single stock vol is high. Volatility is low. We aren't at an all clear, but by the hyperscalers and by the data centers and by the people spending too much money and the people selling them the equipment that's structurally over earning. None of this is a view. This is every possible market outcome out there wearing the same bank logo. And if stocks, this is the point in all of this. This is the craziest thing about how all of this works. If the stocks rise, structural demand was intact. If the stocks fall, the washout is continuing. If the stocks move sideways, we're consolidating. If earnings disappoint, capital discipline is returning to the market. If earnings beat, the secular thesis is just accelerating. No outcome can escape any sell side note. The note does not require anybody to predict the actual future. It is required to make every future institutionally survivable. And it gives the long client a reason to remain long, the seller the reason to have sold, the risk committee the proof that danger was considered, and a guy like Smitherson the ability to say something before the orthodontist ever reaches a treadmill and turns on his CNBC. The purpose is not certainty. It is forwardable certainty. And that is a branded explanation that can survive being wrong. That's it. That's what this is. The deeper truth in this is that not every Wall Street note is a lie. That would be childish for me to say. Oh, the market is rigged. It's not fair. I'm in retail. I'm a retail trader. It's rigged. No, it's doing exactly what it is designed to do. The market is designed, the financial system is designed to perpetually bail out itself out. If you judge everything by its outcomes, you see what the system actually is. So that's that side, right? We see that the outcomes are perpetual bailouts, some sort of new monetary structure that will help stabilize the bond market, bring back stability, and lead to new all-time highs. On this side, in the world of all of this Wall Street banking analysis, it's to protect the shield, right? The analyst can absolutely be honest. The data can be great. And sometimes the conclusion is right, and sometimes it's wrong. The institutional purpose in all of this is probably distribution. And the note doesn't have to fabricate anything or make any crazy prediction about the future. All this stuff does is it rearranges reality into like a sequence that allows everyone important in this market, in this ecosystem, to keep doing what they're doing. Right? That's the thing about it. Like, everybody is playing their part. The Fed is playing their part. The Treasury is playing their part. The hedge funds are stabilizing repo. The private equity is just buying stuff up and ruining kids' soccer. Who gives a shit about that? But in the banking world and in the world of like the whole ecosystem of the financial markets, this research just allows everybody to just keep doing what they're doing. Nobody ever stop and go, hey, what the fuck is this? Like, what are we doing? Why do we do this every day? This is insane. Because when you read all of this stuff, the long client will read a report and they'll go, great, AI, there's structural demand. The short client will read some report and they'll go, well, the cyclical over earnings coming. They might run out of money. This circular money between NVIDIA and everybody else, that's eventually going to hit a wall. It's time for me to turn around and short. The sales desk is going to read and say opportunity, and they're always going to sell you something. Some newsletter person out there is going to go, well, there's a new technology that's on the way, and it's going to separate everything else from everything else that's ever occurred before, and you need to buy my research for $99 a year. An idea that is breathtaking, by the way, like groundbreaking technology, something that you're not going to mention in the promotion. For $99 a year, you're going to get access to the greatest names ever. Okay, that makes perfect sense. That sounds great. So keep doing that, because Wall Street's still defending it, right? Wall Street's still crowding into the AI trade. Risk desks, which is kind of like my world, we're going to say, yeah, there's going to be volatility. And, oh, by the way, if you're a trader, we love volatility. We love volatility because volatility creates opportunity, right? Trade volume weighted average price, trade the daily chart, trade the long leveraged ETFs. Volatility creates opportunities. And everybody plays their part, and everybody moves into their own little circle. And we keep doing what we're doing. The note is incredible because compliance just reads a footnote. Nobody ever has to leave a building. It's great. This is what we do. The note is not a map of the future. It is a chain of custody for blame. All right. So here's Smitherson. Okay. This guy, love this guy. You see this guy a lot. This guy went to Duke and he went to Wharton, probably. If not, he might have gone to Chicago. And if he's really got a chip on his shoulder, he went to a state school. And it's probably Ohio State. And he's like, I don't like those people from Duke or the people who went to undergrad at any of the top 15 schools. And he's always had a chip on his shoulder about that. But when he got to Wharton, oh God, man, it was game on. And he showed everybody how to play beer pong. He works at a firm that he can't pronounce. You will notice that he also wears light blue Oxfords. And he is usually on TV sometime around 7 to 7:30, usually on CNBC. He will tell you that there is a buying opportunity of a generation forming. And Smithy does truly mean it in the moment. And he means it the same way that like a Baptist preacher means the rapture. He has to mean this because it's the only way that he gets to keep his boat at a marina, and he has to get the Scottsdale orthodontist to buy what Smithy's clients sold on Monday. And that guy is usually a load-bearing orthodontist. He is watching this show. He's got his phone out. He's got his screen up. CNBC's on in the background. He is listening to it through the treadmill. He has it plugs into the treadmill. He doesn't really run in the morning because he needs to be able to hear. This is the guy who will buy with the same absence of clients that he uses to floss, right? He will buy with the same absent confidence he uses to floss. Smithy and the orthodontist, I'm telling you, these two guys are married. But the orthodontist doesn't know it yet. And there's a reason for this, because this is the distribution chain of information. This is how it goes for a lot of people. Smithy will supply the narrative in the morning. The orthodontist supplies the order, and the market maker monetizes that order. That's the machine. And before anybody clips this and says, I believe every public company is a hologram operated by Larry Fink from a utility closet in Hudson Yards, I want to be really clear, okay? The earnings are real. Corporate America is making money. Earnings growth are broadening. The infrastructure is being built. The chips are being shipped. I get it. The refineries refine. The utilities earn. They regulate their gains, but they make money. The market isn't fake. It's disturbing, though. It's more disturbing than it is fake. It is very real. It is a well-oiled, well-orchestrated machine that is getting more support necessary from the Treasury and the Federal Reserve to continue to attract capital from abroad, to showcase that we have stability, because this whole game that I am putting out in front of you right now only exists because of what they are doing at the monetary and Treasury policy level. If we break this, all of this beautiful ballet goes away, right? We get up in the morning and Joe Kernan is going, the world is on fire. Becky Quick is asleep at 6:05. And now we have to bring in, Dr. Doom, and he's going to scream at the television, and we just can't have this. We have to have a nice, stable situation where people work with PR directors, people who work in media training, who help get that analyst a little bit of time. They go into a room together at a bank and they record them on air and they talk and they go, okay, next time that you talk about the ability for this company to monetize this asset, I want you to kind of like move your head a little bit. You're kind of hot when your hair kind of like does that. So do that a little bit, like that would go over well. But at the same time, so that would be good. But also at the same time, I think it's important that you kind of flirt with the host a little bit. But then at the same time, also don't be too creepy. Don't wink. Don't wink when you do that. Sometimes you say, sometimes you will say, okay, let's work on trying to get rid of that. Let's get your confidence out. I need eye contact. I need you right in front of, I need you looking directly at it. And I need you to say, yes, Becky, we firmly believe that the long-term thesis remains intact. It's very important for us to think, though, fundamentally that there could be some risk-off event if there are higher for longer narrative around interest rates moving forward. And that's it. And that's all you have to do. You're only on for 90 seconds, and you're going to do great. But let's do 50 more takes so that you are confident, and you will sound robotic the first time that you do it, but you're going to take a couple of breaths, and I'm going to teach you what you have to do. Once you sit down, you're going to sit down with Andrew Ross Sorkin. He's a really nice guy. We just saw each other. Our kids go to school together, not at the same school. We can't afford where he sends his kids, but they're across the street from one another. And I waved to him, and it was great. So you're going to go on CNBC. Okay. This is part of that machine. A lot of PR. People who are on get trained to go on air. I was told by a woman at one point, Garrett, you're not prepared to go on air. And I said, fine, I won't. And I never did, because I let her judge me. She's like, I don't think you have the training. I was like, I went to journalism school. I'm fine. And by the way, I don't care. I'm not selling anything. Who gives a shit? But this is part of the dance. You have to be serious, and you have to make sure that you bring that level of excitement and enthusiasm. You have a thesis, and you have something to say, and you have 4 things that you're going to say, and they're going to ask 4 questions, and you do not stray from any of them, and you don't look down, and you look right at them, and you answer that question. And then at the end of it, they will hit cut, and they'll go, hey, wasn't that great? And you'll say, yes, it was great. And you'll say, thank you for having me. And they'll say, yeah, we'll have to have you back sometime. And then you'll say something like, anytime you need someone with a level of expertise on this, and this, I will drop everything in order to do it. And they will smile at you, and they will never call you again. Okay? So this is part of the machine, and all of that goes away. And all of the world of how we operate in terms of media, and how we focus on the sell side desks, and how we promote stocks, and the whole ecosystem of that evaporates if every single day CNBC from 6 o'clock in the morning until 9 o'clock in the morning is just people running around in the background screaming and stealing snacks out of desks and throwing chairs through the window and trying to escape Manhattan because the bond market has completely and totally melted down and the Federal Reserve has not stopped in to provide enough support. And there are plenty of people out there who are the perma bears who are going to say, well, the market's going to fall 80%, not paying attention to the fact that the whole ecosystem since 2008 has been built around doing whatever is possible to keep this dance going. It is a beautiful dance. We all get to get up and keep doing this shit. It's hilarious that we all get to get up each day and keep doing this, and we do it every day, and nobody raises their hand and says, this is insane. And then they say, yeah, we have to keep doing it. Do you understand how expensive schools are in Manhattan? And I'm just trying to get out to Long Island for like one night to stay at a Red Roof Inn, but it's $708 a night. But the funny thing about this is that as they provide all of that support to the financial system itself, certain people benefit before others do, right? Some players in the space get better terms, better access. Some of us are just living on scraps, but we're just happy to be clinging to the helicopter, and it's Ken Griffin's helicopter. And Ken Griffin's got like 6 of these things, and he's going to the Bahamas, and he's the market maker. He's Citadel, and we're on the last rung of the rope hanger, and we're rope ladder, and we're hanging on to it. I'm hanging on to this, and I'm hanging on to it. I'm saying, thank God that Ken Griffin has access to capital every single day and is able to ensure that he works with the best financing channels in the world, because the bad bear will say this whole thing is a scam because prices are too high, and a bad bull will say prices are high because the future is bright. Both eliminate the mechanism because the mechanisms are inconvenient and don't fit on television. A stock price is earnings, valuation, balance sheet capacity, positioning, collateral, passive flows, volatility targets, option hedging, ETF rebalancing, and whatever the hell it is that Smithy will say it is at 7:20 that morning out of one bloodshot eye as we're waking up and just trying to push our kids out the door. And some of us do get to go to the gym and listen to him, and then we go into Robinhood and we buy that ETF or whatever it was that his client sold the other day because he made a compelling argument, but he also used hedging language to ensure that he protected his ass in the event that this does go sideways. The cash flows, of course, are real. The ownership structure is insane. The productive economy and the financial machine are welded together, and that weld is where all of these fees live. Retail is buying, and retail will not stop buying. There is a ferocious desire for us to buy a leveraged ETF with the expectation that it is going to triple, and we'll be able to make that $60 that we need in order to pay Netflix. Vlad Tenev is watching a heat map. The American retail investor has been trained to buy every decline as though the dip were a moral obligation. And the barbarians can be climbing the walls of Rome, and somebody's on Reddit right now asking whether the invasion creates an attractive entry point in regional home builders. The smart money exists through just exits, it just runs, it just screams out a bathroom window carrying a garbage bag of cash. And retail and venture, it comes back through and they go, hey, well, this is a buying opportunity of a generation. They've got a Yeti fanny pack. It's got money in it, and they're waiting for opportunities to buy. And the index remains flat, and television just calls it a healthy rotation. And the ETF machine is now trading the investor. They're saying, look, this Wall Street bank said that a leveraged semiconductor product has become a meaningful source of a short gamma. And in plain English, when stocks rise, the products must buy more. And when the stocks fall, they have to sell more. And the formula trades in the direction of the move, and it helps create the next move. And that's the part that should bother you. One derivatives desk says individual stocks have never been this volatile relative to the index, and the index looks calm because all the screaming is happening inside the components. Their fragility gauge is sitting at 0.9. It's nearly maxed out before systemic strategies are even fully levered. The market is not peaceful. We have moved the bar fight into 12 private dining rooms and turned down the music in the lobby. That is where we are, right? This is what we are looking at. Up markets, ETFs have to buy more. Down markets, they have to buy less. This is not an investor. This is weather at the end of the day. This is weather at the end of the day. So what do we see here, right? We see people who are basically just releasing information into the system, into a market, and these ETFs that are just going up and down based entirely on a prospectus. Up market, they got to buy more. Down market, they got to sell more. And then everybody chases that. And Robinhood's going crazy. And then Smithy is on talking about the buying opportunities in the ETFs and buying opportunities in this one long systemic trade in AI. And these products, again, we're not creating investor products. We're betting on weather. And the real question that I have to ask is who actually asked for any of this? The people who asked for this were not the retail investor. Okay? This was 12 people in a conference room. And that conference room had a couple of different people in there. Compliance was probably in there. Legal was probably in there. Marketing was definitely there. Distribution, 100%. So most likely there's this guy, right? You have a product manager named Brent. And this guy printed copies of his deck. Nobody asked him to do that. Nobody asked whether or not this thing should even exist. And the first slide probably says something about access, and the second slide says something about innovation, obviously innovation, right? And slide 3, and this is usually the best part of these presentations, it probably had a young couple looking at a phone, and they were sitting beside a lake. And the couple looked happy because the photograph was taken before anybody explained compounding of leveraged ETFs. And Brent said the product would be very sophisticated. It would be very sophisticated for tactical exposure for self-directed investors. At that point, when you have something like that, right, compliance will ask whether the risk disclosure would be prominent. And of course, it's going to be prominent. It would be available through a hyperlink beneath a green button on Robinhood. That's all you need. And then legal would ask whether the fund could nearly lose all of its value under extreme conditions. And the portfolio manager would say yes, because at this point, what you have to understand about these funds is that people relax because extreme conditions are actually legally different from the conditions that happen repeatedly. And this is how the financial industry responds when somebody notices there may be too much tequila in the drink. Do we remove some of the tequila? Absolutely not. We forgot the tequila was even there. Here's what you do, right? Think about the fact that we may all be just like, we had ETFs, right? We had ETFs that we could drink, that we could use, we could drink. And like an ETF that was like a semiconductor one, we could just, it'd be like a Long Island iced tea. And you know what? What we don't need to do is we don't need to do anything that would mitigate risk. What we'll do, instead of taking the tequila away from everybody, what we'll do is we'll just put it into a bigger glass, right? So now they've got more room, margin for error. So that we'll get rid of that ridiculous 14-ounce glass, and we're going to put it in a 22-ounce glass, and we'll pour it in, and then we'll, depending on their risk tolerance, we will allow them to add more to the glass. Are you going to add more mixer? Absolutely not. We're going to put more rum and vodka and whatever else is in a Long Island iced tea. I haven't think I've had one since I was like 19 in New Jersey, and I think that was enough. So the reality is, like, we'll just put it all in a bigger glass. Okay. So we're going to add 7 different new types of this, and we're going to take it out of that ridiculous 14-ounce glass, and we're going to put it into a 22-ounce glass, and we'll add 3 more shots. We're not adding any more mixer. Stop being a coward. Okay. The mixer was suppressing the intended exposure. We're just going to go for it. And now the next thing that we have to do is come up with a name for this fund. And my vote is to put Ultra on the glass. Put the word Ultra on the ETF. That tells everybody that you can really fuck you up in a good way or in a way that ultimately leads to life-changing financial decisions that may impair you into perpetuity. We're going to add a small warning beneath the napkin. It's only going to go beneath the napkin, and it's going to go under the napkin, and it's going to explain that the beverage is designed for sophisticated tactical drinkers who understand daily resetting and are drinking enough water. And then we're going to hand an 18-year-old in a bathroom at 11:48 on a Tuesday night a phone and an account, and we're going to say, would you like options approval with this? Would you like to enable securities lending while you're unconscious? This is the entire product development's philosophy. We didn't look at leverage and say, perhaps there should be less leverage. We looked at the leverage and we said, the glass is too fucking small. The problem wasn't the tequila. The problem was the access. The problem was that the Scottsdale orthodontist could only lose money at the speed allowed by an ordinary brokerage account. We had to democratize blacking out. We had to put Blackout behind the ticker, okay? We had to make the blackout trade from 9:30 to 4, reset every single night, and send a push notification when the blackout fell 20%. And somebody in that room said correctly that sophisticated investors may want this exposure. Sophisticated investors may also want to fight a police horse outside of a playoff game. That doesn't mean the New York Stock Exchange had to list the opportunity. Nobody asked if this thing should even exist. That's the point, okay? The next question had nothing to do with if this product should exist. The question was outside of that agenda. The question was whether the fee should be 95 or 99 basis points. And then the next question, which was after they approved 98 basis points, between the chicken Caesar that Brent was eating and the discussion of whether Ultra required a trademark symbol. 3 months later, the Scottsdale orthodontist bought it on a treadmill. So did his kid, who also drank 2 Long Island iced teas. And he didn't read any of this. He didn't attend a product committee. He didn't even get a bite of Brent's chicken Caesar wrap. He got a fucking hyperlink to a prospectus on a cell phone in a font that can only be read by owls. We didn't design an investment. We just put all this shit behind a ticker, panic behind a ticker. And we designed a panic reflex with what is known as a CUSIP. Then we gave Brent a promotion because first month assets exceeded expectations. Once again, I remind you, this product cannot think. It can't wait. It can't decide. It can't decide that a move has gone too far. It can't do anything except follow a single instruction. And that instruction is very easy. Is the market going up or down? Buy more on the way up, sell more on the way down. Use total return swaps in order to generate returns that mask or replicate 200% of the underlying security, or in the case of the indices that they might be tracking, 300%. We took panic We removed the human capacity for hesitation. We put it in a ticker. We gave everybody confetti, and we advertised it as democratization and innovation and access. And then the feedback loop in all of this begins. And the strategist says that the move is technical. Of course it's fucking technical. We built the machine. We wrote a formula and we licensed an index. We collected a fee and then we stood over the wreckage asking if anybody had seen the driver and how much tequila you drank that night. The stock falls because the product sells. The product sells because the stock fell. And then a note arrives explaining that the move was driven by technical factors or broader market conditions or concerns around the Federal Reserve interest rate. And this is the shit that drives me crazy, because all you have to do, if has a basic understanding of how markets actually are functioning in the post-2020 world, right? If you turn around and you pay very close attention, just look at the National Economic Conditions Index, turn it upside down, right? Flip it upside down. Since COVID, it's literally the S&P 500's directional moves. Federal Reserve and its activity and the Economic Conditions Index set by the Treasury and the Fed, largely a Jerome Powell trademark operation. Economic Conditions Index, when it loosens, guess what happens? The S&P 500 is going up. And when it tightens, the S&P 500 is going down. It is following the same wavelength. It's not going to be line for line, but it looks like two cousins that look very similar, but one is like 7 inches taller than the other one. And the smaller one's kind of got like a weirder nose, but they both look almost alike. Like you could definitely say, all right, like they are related. That's where we are. And I made a joke that if they were both musicians, if the S&P 500 was a musician, and so was the Economic Conditions Index, and the Economic Conditions Index had a song, and it was about its movement over the last 7 years, and it was a great song. And then all of a sudden, the S&P did a song that was similar because they had the same movement. The Economic Conditions Index could sue because the beat sounds exactly the same. The line looks exactly the same. This is what got the song Blurred Lines into trouble. Remember that hot mess? Well, you can't undo it now. Enjoy your Saturday listening to Blurred Lines. Now, one last thing about this, right? They will tell you the S&P 500. You'll look at CNBC and you'll say, "Why are semiconductors off 8% today?" And they'll say, "Well, because Trump administration is reorganizing a war effort against Iran." No, it's technical selling, and it's built on top of that. It's tied to these leveraged funds that are taking over this market. There's no world right now where the mechanical buying in this market, the passive flows in this market, are higher now on an aggregate basis than the people who are, just doing what Warren Buffett did. Value flows have got to be in the low teens at this point. Leverage funds are probably in the 30s, and passive flows are over 50%. And then you've got active managers who are 1 in 5 are actually beating the market. How do you even keep up with this when all the concentration of risk is tied into this, and you've spent your entire life studying, hey, I need to look at the company's price to earnings ratio, its PEG ratio, its return on invested capital, its enterprise value to its EBITDA, to understand what it's going to do over the long term. What is the expected earnings expectations? What does the revenue look like? And all of these people are spending all of this time doing all of this research, writing all of it up. And they're like, why is Berkshire Hathaway trading at the worst spread that it has been on the S&P 500 since the dot-com bubble? What's going on here? Well, let's go back to the original thesis. Liquidity, momentum, mechanical buying, policy. Same shit over and over again. It's been this way since 2008, but it's really accelerated since COVID. So once again, technical factors mean that the machine did the thing that it was designed to do, and everyone is pretending it appeared overnight in a cornfield, like shoeless Joe Jackson. The market maker, this is all mechanical. This is how it all works. Everybody's collecting fees. That's the incentive in all of this, okay? The market maker gets a spread. The sponsor gets a fee. The exchange gets volume. The network gets a segment. The orthodontist gets a push notification asking whether he would like to enable securities lending. And the reality is, even the loss has a business model. Even the loss has a monetization strategy. The Federal Reserve, the community theater company of the Federal Reserve, presents Resolve. Central bankers spend half their time insisting they're independent and the other half watching the S&P 500 like a mother watching a toddler approach a swimming pool. Chairman Warsh already promised to deliver price stability. No forward guidance. He promised task forces. He promised fucking task forces because what the Federal Reserve was missing was more bureaucracy. This is a place, I shit you not, the Federal Reserve has 12 regional banks. It has a board of governors. It has more than 20,000 employees. It has hundreds of economists that have PhDs. It has a beige book. It has a dot plot. It has minutes. It has press conferences. It has the summary of economic projections that go out and enough models to predict unemployment in several countries that don't even exist anymore. And now we're going to get task forces. We're going to get a communications task force. We're going to get a balance sheet policy task force. We're going to get a a data task force. Productivity and jobs, inflation framework task force. These are not obscure side issues. These are the 5 things the Fed claims it does. This is the Coast Guard announcing new task force for boats and water and navigation and drowning and making sure that people don't drink Long Island's and get onto a boat called long-term expectations. What have you people been doing? And we're not just bringing in any task force, by the way. We're not building anything. We're going to bring in, which is nuts, we're going to bring in people already standing closest to the policies. We're bringing in accomplished economists. We're bringing in business leaders. We're bringing in former central bankers. We're bringing in people who are already standing right next to the balance sheets and already benefiting from higher asset prices. They're going to fly into Washington. They're going to enter a conference room where, again, I don't know what they're going to even do. And they're going to close the door and they're going to provide candid feedback, right? Because nothing creates candor like a secured Federal Reserve conference room filled with people whose resumes require that the conference room remain important. We have Mark Edridson to help examine productivity and jobs. Doug McMillan is going to be examining economic data. The CEO of Xbox is going to be there. Apparently, the labor market is now a downloadable expansion packet. The task force will meet at 8. Venture capital will explain that inflation is partly a narrative problem. Walmart's members are going to say, once again, that eggs are expensive. That's not even a central banking issue. That's just bird flu. And then some economist is going to sit around and he's going to draw a Phillips curve. And then the former Walmart executive is going to ask if the curve can unload a truck of eggs. And then the Xbox executive is going to say that market engagement remains strong. And then someone from the Federal Reserve will write in a document that engagement remains strong. And they're going to write it on a legal pad and they're going to circle it 3 times. And then everybody's going to go to Ruth's Chris. And they're going to go to the Ruth's Chris over on K Street. And it's nice and everybody likes it. They had thought about going to a place down in the Wharf. The Wharf's really nice right now in Washington. They just did it with government money over the last decade or so. But you know what? It's just easier to stay on K Street because then they're going to be able to meet with all of their lobbyists, right? Because that's right there. So It's not as good as the Roost Chris that closed in Baltimore, where everybody went during the trade shows, but the country is declining in very specific ways. And one of them is that you can no longer get a consistent rebuy near a convention center. And my message is this. I don't know why these people are going to be on the task force. We should put me on the task force. We should find a guy who worked at a steel plant that was replaced in the 80s, and now it has been moved to Thailand. We should look for the guy who was working a nice middle management job at a company that got displaced by the dot-com boom, and now he is driving DoorDash, and he's doing Uber Eats, and he is also occasionally picking up a few hours at like a GameStop. He does not have health insurance. He pays both sides of his Social Security because he is a 1099. And that is what economic freedom is really about. His car needs brakes. He is working 3 jobs, and the jobs report would actually say that this man is resilient. But that man is exactly who should be running the Productivity and Jobs Task Force. Don't invite him for stakeholder feedback. Give him the fucking gavel, man. Put Mark Adrianson in a folding chair by the wall and make him listen while this guy explains what technological productivity feels like when it arrives in your town and converts your building into apartments. But that guy is not going to be there. We're going to have Harvard economists, and we're going to have former central bankers and business leaders, and their names will be on cards, and somebody will say fit for purpose, and will say the words analytical framework. And while they're studying all of this, the machinery will continue operating underneath the whole conference room. It's all theater. We're going to keep doing the standing repo facility the whole time. We're going to keep doing central clearing the whole time. The Treasury will still be issuing a shitload of debt. We're going to be at $40 trillion in October, by the way, right? The hedge funds are still going to be doing this basis trade. Doug will still be ordering fish finders. He'll be out there right now. He will call you to tell you that he is moving from international value into a more tactical opportunity because he just saw a report on CNBC that the buying opportunity of a generation is happening right now in AI. And if we don't get on here, we're going to miss it. And this is the opportunity. And the real question is, what is the task force actually for? You're already changing the plumbing in the financial system. You're already deciding which markets can't be permitted to fail. You're already supporting the collateral in the system. This is theater built on top of machinery that is already moving. So the broader task force roster studying the consequences of monetary policy is drawn from a class of people that lives much closer to asset prices than their grocery bills. I'm not saying they're unqualified. I'm saying the task force is professionally very excellent at surviving inflation. And the average American gets an inflation number. The task force gets an asset. And after 6 months of rigorous fucking findings, they're going to announce the communication could improve, artificial intelligence creates opportunities and risks, that data should be timelier, and that the future remains uncertain. The report is going to be rigorous. You're going to be able to download it on federalreserve.gov, and the decision will remain data dependent. And of course, Warsh will decline to submit a dot plot, which is apparently tough now. So anyway, the dot didn't exist. Nobody could point where it didn't exist because the dots are anonymous. This did not slow television down. CNBC still found a way to circle the absence in red. And by lunch, the dot that didn't exist had become the more important dot. The reality is we are spending $970 billion right now on interest. $970 billion. We're racing toward another $1 trillion fiscal year. Okay? Federal debt is now scraping $40 trillion. $40 trillion, and gross interest expense has crossed $1 trillion this fiscal year. We didn't race toward that number. We arrived early and we found that Treasury sitting alone at the table staring into a glass. The tough guy routine here has limits. If you raise rates too far and government's own financing costs become the emergency then. If you keep them too low, households receive inflation. The Fed will lecture you about price stability while the fiscal system quietly requires a rate structure that doesn't detonate itself. This is not a conspiracy. It is arithmetic wearing a lanyard. Japan is the loose floorboard beneath the global asset complex. And Japan, again, supplied one of the world's favorite raw materials, which is cheap money. Institutions borrowed in yen. They moved the money somewhere else and bought whatever paid more. They bought treasuries. They bought corporate bonds. They bought technology stocks. A private credit vehicle financing veterinary clinics in Arizona. The yen carry trade is not one trade. It is a global drug habit. The habit became part of the price, and now Japanese yields are rising, and the yen is fragile, and the Bank of Japan has 3 doors with a fire behind each one. So picture the asset liability meeting at a large Japanese insurer. 14 people sit at a long table, 13 dark suits, and 1 woman who understands duration. And for 20 years, this meeting was easy. Domestic bonds paid nothing. Foreign bond assets, that's what we want to buy. The Japanese yields then rise enough to make the room uncomfortable. And the woman turns to page 37, and she says they may now earn a respectable return without sending a policyholder money 6,000 miles away, converting it into dollars and hoping that the Federal Reserve doesn't have an episode. And the room gets really quiet. And this is how global capital moves. It's not with the trumpet. It's with 14 people staring at the page 37, and a new term comes up. This new CIO asks whether reducing foreign exposure could be described as quote unquote home market optimization. And she says they can call it whatever the fuck they want because some of the money can still come home. And a junior analyst who has been waiting 6 years to use the phrase gradual normalization of geographic allocation. Meanwhile, the United States Treasury assumes these people are still at the party because their coats are still in the chairs that they left them on. They're really in the elevator, and their coats were actually decoys. And the Treasury asked the bartender whether anybody has seen the Japanese insurer. And the bartender said they left 20 minutes ago, man. What have you been doing? So they raised Japanese rates quickly, and the carry trade can unwind. And that's exactly what happened in August 2024. And if they suppress yields, the currency weakens further. If they intervene in the currency market, and every macro fund on earth tests them now, how much money the finance ministry is willing to spend before lunch. This is not a policy choice anymore. It is a hostage exchange. And it matters because Japanese institutions own enormous foreign portfolios. As home yields become more attractive, the marginal buyer of American debt has options now. The position has always been funded in yen, from Tokyo to the London risk desk to the New York collateral to the 401k that's sitting in Maryland. The asset was bought in dollars. The risk manager is in London. The New York is where the place where the collateral lives, and the loss appears on the retirement account where I am in Maryland. And again, globalization achieved its final form when nobody knows which country ruined somebody's Tuesday. Wall Street caused this monetary policy divergence. The house is sliding into the fucking ocean, and the brochure says enhance water access. Repo, in plain English, for the 4th time this month, because nobody in the financial press will do it for me. Let me explain repo one more time in plain English, because none of the AI trade or the Fed volume knob or Smithy's vest matters if you don't understand what is happening in the pipeline that is happening under this market. The equity markets are great. We talk about them each day. Let's talk about repo. For anybody who has never worked on a trading desk that would prefer not to, okay? This is Wall Street's pawn shop. You own a treasury bond, you own a treasury bond, you own a treasury bill. You need cash today. You go somewhere and you hand the bond to somebody and you say, I need cash, and they give you cash, and they're going to hold it overnight, and they give you cash, and you promise to buy that bond back tomorrow morning at a slightly higher price. And that difference is your interest rate. It is the SOFR, the Secure Overnight Financing Rate. Okay? It sounds boring until you realize that this is how hedge funds turn a small amount of capital into a gigantic treasury position. It is how dealers finance their inventories. It is how money market funds park overnight cash before the sun comes up. It is how the treasury market checks each morning to see whether or not civilization still has food and electricity. And when repo behaves, nobody covers. Nobody gives a shit. When repo breaks, every central banker on earth wakes up at 3 in the morning at the exact same time, and they start texting people whose names are stored in their phones only as initials. The treasury basis trade is easily defined as picking up nickels in front of a steamroller. Okay? It works like this. The treasury basis trade, which is the reason we're all here every day, the specific trade regulators are terrified of this thing. Okay? They're terrified of this thing. Okay? All it is, right? A large relative value fund, value hedge fund, okay? It will find a tiny pricing gap between a cash treasury and a corresponding futures contract sometime in the future. So it buys the treasury, it finances that purchase in repo, and shorts the corresponding futures contract. Then it repeats the position across billions of dollars because the spread itself was too small to matter without leverage. This is not complicated. The size of the forklift required to pick up the nickel is the complicated part. Across billions of dollars, this microscopic pricing gap eventually becomes real money that the manager can collect a performance fee on. It's picking up nickels in front of a steamroller, except the steamroller is the United States Treasury market, and the person picking up the nickels has convinced policymakers that his continued nickel allocation is critical national infrastructure and a secure buyer of U.S. national debt. And when this works, the fund keeps the profit. But when the manager, he gets to go collect a fee, the public receives a 45-page speech about market depth. And when something moves against this trade, lenders start to demand more collateral. Every other hedge fund running the same trade begins solving the same equation at the exact same time. And that equation only has one answer. Sell something before somebody else does. And a private position has become a public emergency inside about 72 hours. And that's when the vocabulary changes. And that's when the plumbing changes. And that's where we start creating a whole host of new alphabet bullshit in order for us to preserve this. And it's going to get to the point, I swear to God, because the Bank of England's already doing it, as I will explain, that they are going to just eventually just start handing money to the hedge funds. They're going to go, okay, thank you for buying our debt. Thank you for doing this positioning. Thank you for holding, I don't know, $1 trillion in U.S. debt so that nobody else does. We're sorry that this has gone awry. Here's some money. And you keep doing this, please. We just can't have the Federal Reserve doing it because that would look really bad. Nobody at the Fed will ever say that hedge funds made a bad bet. Janet Yellen last year said, well, we had some leveraged hedge funds selling U.S. treasuries. And then the Australian Financial Review never asked the follow-up question of, what do you mean? Why is that a thing? Nobody asked that. They'll say the treasury market is just experiencing minor dysfunction. And nobody says the lenders finance too much leverage. They'll say there's a temporary shortage of market liquidity. Nobody will say that Wall Street needs another rescue. They will say that the central bank must protect market functioning. Market functioning has rescued more wealthy people than the fucking Coast Guard. And a normal person loses money and it's personal responsibility. A hedge fund loses it and it's quote unquote impaired intermediation capacity. It's the same failure. It's just better stationary and a better Rolodex. And the vocabulary keeps changing, and Doug keeps ordering fish finders because that's what this guy does. And we talked about this. The Bank for International Settlements told us in the June 2026 annual economic report in language unusually direct for a central bank publication that roughly 70% of bilateral repo with dollar transactions with hedge funds occur at zero haircut, which means that on the repo leg, the hedge fund can borrow 100%, $100 against $100 of Treasury collateral without posting $1 of excess collateral. The fund still has to post margin on the futures side, but the cash leg, the place where the leverage actually breathes, arrives without any extra cushion. And the lender, some large regulated financial institution with its name on a stadium, finances that cash leg at par and calls it prudence because the collateral has an eagle on it. Now, this is where I introduce you to Kayla. She is at Chase, and I want you to try that arrangement with her at Chase. I want you to go in it on a Monday, wear a very nice sweater, please, and ask her how her mother is. Sit down across from the personal banker whose nameplate is a small piece of black plastic. Probably plant does not look good. The plant is struggling because nobody at the branch is entirely sure whether it belongs to the bank or to her, and everybody's afraid to actually ask. So say to her very politely, listen, Kayla, I'd like to borrow $100 against $100 of collateral without posting $1 of extra cushion. And that's where she stops typing in your name and she looks at the manager's office, and a small light probably starts flashing under her desk beneath a framed photograph of a family opening a checking account. And within 4 minutes, a security guard named Reggie is standing right next to you, asking you if you would like to continue this conversation in the parking lot. Now, Reggie has heard almost everything in his career, but even Reggie is offended by the terms that you are actually pitching. And meanwhile, if you are a $20 billion hedge fund, a major bank calls this an important client relationship. This is what the BIS was trying to tell us when it used the phrase lax funding terms in its annual economic report that I covered in a video about a week and a half ago. The BIS now says targeted minimum haircuts deserve serious consideration, which is a polite academic way of phrasing for forcing the basis trade to bring some padding with it before the whole thing blows up on a Tuesday and takes everything with it. But that creates a small problem. If hedge funds now all of a sudden have to bring some of their own money, where are they going to get that from? Some trades will now suddenly become unprofitable, and the funds will shrink those trades, and some of the funds will leave that entire market, and suddenly there are fewer leveraged buyers of U.S. Treasury debt at exactly the moment that the United States Treasury actually needs more buyers. We're nearly $40 trillion in debt, and we continue to move more and more of this debt to the front end of the yield curve. We used to only be in like the low teens in terms of things that we would have to roll over every single year. Now we're at 22%, and that number is climbing. We keep selling short term because we don't want to have to pay interest rates at 5% on 30-year, 4.5%. So we go to the front end of the curve, and we hope that interest rates will go down, and they're not. So shit, what do we do here? Well, regulators have to reduce the leverage without losing the actual leverage buyer. So they need the alcoholic to stop drinking. You got to stop drinking all of these Long Island iced teas. But the problem is they also own the bar, right? So the alcoholic has to stop drinking, but they own the bar and they know where the keys are. And that's not policy. This is a family therapy with a Bloomberg terminal. So you have to reduce leverage, which this is the big problem right now. This is like, people are going, what the fuck are you talking about? This is the problem in the financial system, okay? Don't look away from this. Stare at it. Remember, you are upgrading your credentials. You are making sure that you are staying abreast of what is happening in the financial system, because this is the whole machine. They have to reduce leverage. They need the buying power created by the leverage at the same time. They need the hedge fund to be disciplined, but they need the hedge funds at the next Treasury auction. They need genuine price discovery, but they can't tolerate the price that genuine discovery might actually produce. They want the trade smaller, safer, better margined, and fully cleared, but they don't want $1 of demand to leave the fucking room. They want to market prices without the market being allowed to finish my next sentence, which is, what the hell is that? This isn't a free market, because a free market allows failure to reach the period at the end of the paragraph. A free market allows failure to just exist. This system interrupts failure halfway every single time, changes the vocabulary, opens a new facility, stabilizes the collateral, and then returns the institution to the table with a cleaner haircut and a panel invitation at Davos. The private sector earns the spread. The public sector preserves the market every single time. The hedge fund receives no direct bailout, which is legally important but economically fucking hilarious. The government doesn't rescue the man, it rescues the air around the man. And that is the key difference of how this system actually works. It always rescues the floor right beneath the guy who is about to blow up, the bank that's lending to him, the collateral that is posted by him, the clearinghouse that is standing between his default and everybody else's balance sheet, and the Treasury market that now requires this same guy to keep showing up. We need people to be able to eat more healthy sandwiches at our restaurant, but we really make the most money on the Long Island iced teas. So we need this guy to come back and drink more Long Island iced teas, but we have to make sure that he's healthy. This is the financial system. And then a U.S. senator gets up and they ask whether taxpayers bailed out hedge funds. And the answer is no, certainly not. We merely prevented every condition under which the hedge fund would have been forced to discover what losing actually meant. Easiest way to put that. The trade can't fail. The institution cannot lose the meeting. It's the same thing. The institution can't lose the meeting. That's the intellectual heart of all this. None of these people want capitalism. They want capitalism with an institutional undo button. And the undo button is behind glass in a building that none of us are allowed to enter. The great modernization, that fucking word, the regulator's answer is central clearing, sponsored access, faster settlement, tokenized collateral, standing liquidity facilities. And some of this shit's sensible. Positions net, regulators get visibility in all of it. Dealer balance sheets they might be used more efficiently, but risk doesn't disappear. It just moves somewhere else. So when a regulator says that risk was reduced, ask where it went. This is why when Jenny Yellen said, I don't think we're ever going to have a financial crisis again, this is what they were doing. They're rewiring everything. And then they claim, well, there's not going to be a problem. And then you look and see what actually has happened with 2020, with the race for cash, and then the need to, what happened with the gilt crisis and things blowing up. So we better provide access to non-banking financial institutions and ensure that they have access to capital at any given moment. Bank of England, that's going to be a thing. And we sit here and we go, what is this? What actually is this, right? Whenever a regulator says that risk was reduced, ask where it went. When Janet Yellen said, well, we had a bunch of hedge funds, leveraged hedge funds selling bond positions, nobody stopped in that interview and said, wait a minute, what? Like, I knew that existed, but most people don't know that this is the undercurrent of the market. Janet, hey, explain to us what that leverage basis trade is, but also explain why it exists. And you can be completely honest about it. And actually, refreshingly enough, in the last 7 to 9 months, Logan down at the Dallas Fed and then Powell, they talked about the repo market. And then they were very transparent leading up to that decision in December to basically say, hey, we're going to remove the cap on this. And then at the same time say, hey, we're going to also print a bunch of money, but hey, it's not QE. This is just liquidity management, baby. That's just all this is. When a regulator says this, ask who supports the institution holding the risk when the new container begins to show smoke. Before reform starts, and this is very important, before reform starts in any market, risk is usually scattered across a filthy web of bilateral relationships that nobody else can see. And after the reform, it sits inside a beautifully governed central institution with committees and default waterfalls and recovery plans and a nice reassuring shade of blue on a logo. You got to have that reassuring shade of blue. And then everyone agrees that the blue institution cannot fail. And we never eliminate fragility. We gave fragility bylaws, okay? We give fragility a risk committee, a conference in Boca. We transform about 1,000 possible failures into one unacceptable failure and call the result robustness. The bomb used to be hidden in 12 different apartments, and now it's just in a lobby with a visitor badge. The bomb signed the visitor log. The bomb watched the workplace safety video. And a woman from operational risk named Janice is now asking if that bomb has dietary restrictions for the working lunch. Nobody's removing this bomb, okay? That's outside Janice's remit anyway. The bomb belongs to a systemic risk oversight. Systemic risk oversight meets quarterly. The next meeting will be in Boca Raton, and the bomb is speaking on a panel called Building Resilience Through Cross-Functional Preparedness. It is a media training. It has a LinkedIn profile. The bomb has been nominated for excellence in systemic resilience. Janet has booked a table for all of us. The only acceptable outcome is that the bomb misses the resilience workshop. That is how concentrated risk becomes respectable. You don't remove it, you give it governance. You produce a recovery plan explaining what happens after it explodes. The recovery plan is excellent, everybody. The recovery plan has tabs. It's color coordinated. We have talked about it extensively. That's what we were doing at the last FOMC meeting. We did not talk about interest rates or the jobs market because honestly, who gives a shit? The whole point of all of this is to ensure that we have financial stability. We have to have financial stability. So we already have a recovery plan in place. But even though that recovery plan is going to fail, we are going to make up the next recovery on the fly, and we're going to bolt the wings to that plane when it is time for us to all fly away from this incredible train wreck, because the bomb can explode, but the institution can't lose the meeting. We didn't eliminate concentrated risk. We institutionalized its calendar. The SEC's clearing deadlines, oh God, they're approaching. So cash treasury transactions will move first and repo will follow. Pay attention. Clearinghouses, sponsor banks, and technology vendors are racing to finish the plumbing that is happening right now. And this is exactly the point that Handley was making. This is what I encourage you to read what Glenn was talking about at the desk. The DTCC is moving tokenized securities into limited production. Holy shit. While working on an industry group of more than 50 firms, followed by a broader October launch. This may improve settlement and let collateral move faster. It may also mean that margin calls, collateral substitutions, and liquidations can move faster. Faster is efficient, but faster is not always cleaner. A tokenized treasury is still a U.S. treasury, and a blockchain margin call is still a margin call. A smart contract doesn't pause and say several participants appear overwhelmed. It executes. They're installing a Formula One engine in an ambulance and congratulating one another on the travel time. Meanwhile, Larry Fink is probably somewhere in Hudson Yards right now watching the new rail take shape with a small, restrained smile of a man who once identified where to install the toll booth. Crypto was supposed to eliminate intermediaries, and every intermediary in North America put on a blockchain conference badge and walked back inside. Stablecoins. Remember those things? Yeah. 5 years ago, they were sold as an escape from the banking system. Treasury Department has discovered crypto is useful when crypto buys treasury bills. Well, now they are becoming a distribution channel for short-term government debt. The Treasury needs buyers of bills. Stablecoin issuers need safe, liquid reserves, legally binding. So the government looked at crypto looked at the federal debt, and both realized they had confused ideological differences with a revenue opportunity. And the customer hands over $1. Well, the issuer parks much of it in treasury bills and other short-term reserve assets. It keeps the yield and gives the customer a token that says $1. This is banking with the furniture removed. When that dollar comes out of a banking deposit, the bank loses cheap funding. The stablecoin issuer buys bills. The treasury gains a buyer. The intermediary never disappeared. It changed clothes and began using ecosystem as a verb. The dollar is becoming an API with a private toll booth attached, and the circle is pretty remarkable. Now, once again, what we are seeing is more demand for U.S. Treasury bills, seeing where we are right now. What's happening right now is that deficits will create issuance. Deficits are going to create issuance in the financial markets. All well and good, right? More room for that deficit, more opportunity for us to transfer them dollars. All right. Bills will create yield-bearing collateral. That collateral is backed by backing those stable coins. Stablecoins are marketed as the future of money. The future of money, therefore, requires a government to keep issuing debt that the future of money will hold. Which means that we just solve fiscal dominance by turning it into a product roadmap. Crypto was supposed to overthrow fiat money. And what did we build? We built a money market fund with a Discord. This is Brock. He spent 7 years explaining that sovereign currency was a tool of control, and that if you are using their money, you are a slave to them. He recorded 1,200 hours of a podcast from a rented villa that was separating, all about how to separate your money from the state. And now he sits beside the deputy assistant to the Treasury at a Four Seasons conference. The panel that he is going to be running is going to be called Public-Private Pathways towards responsible digital dollar adoption. And Brock is wearing linen. The Treasury official will wear navy, and they will agree completely on everything. They will agree that stable coins need high-quality reserves. They will agree that Treasury bills are excellent reserves. They will agree that regulatory clarity will suddenly create more demand. Nobody mentions the revolution that they were going to hit. Nobody talks about the fact that the goal was to destroy the institution. The institution gave this guy a lanyard. And now the revolution is outside waiting for the valet because Brock handed it the wrong ticket. And at the reception, Brock receives a Treasury challenge coin and places it beside his hardware wallet. The state didn't defeat crypto. It discovered that crypto could help distribute the debt. The government gets a buyer. The issuer gets the reserve income. The exchange gets volume. The user gets to believe he escaped the fucking system. The only thing that disappeared was the revolution that was promised. It's hilarious. But the risk also changed clothes too. A stablecoin promises one token equals $1 instantly in size. And that promise works until every body wants the dollar. Then the issuer sells reserves. If the run is large enough, the government may need to stabilize the same bill market backing the private token that was supposed to transcend government money. Finance privatizes the front end, and then it socializes the fire exit. The BIS called the underlying requirement the quote-unquote singleness of money. $1 in a bank, a stable coin, a money market fund, and a tokenized settlement rail must remain $1. And if one of them trades at 99 cents, the future of money begins resembling an airport currency kiosk managed by venture capital. Larry Fink, therefore, is already at the toll booth, and he has exact change. And that's where the bailout machine starts to appear. Okay? The standing repo facility doesn't lend directly to hedge funds. That is true. Hedge funds borrow from banks and dealers. Eligible depository institutions and primary dealers can access the standing repo facility. The fund sits at one end of the chain support and the central bank at the other. So when the chain bends, the surrounding institutions are reinforced. The Fed can honestly say it didn't bail out a hedge fund. It stabilized the dealer. It stabilized the collateral. It stabilized the funding market and the Treasury market. This is the extension cord. They rescued the air around the man. It didn't rescue the man. The Bank of England has gone even further than this. They created a contingent facility for participating insurance companies, defined benefit pension schemes, and liability-driven investment funds. And during severe gilt market dysfunction that will threaten financial stability, those institutions can now borrow against gilt collateral. The entire direction and game is clear. Central banks that once stood mainly behind banks are extending the perimeter because the financial system now depends on non-banks like hedge funds. The shadow system is now no longer in the shadows. It's in your kitchen, wearing your bathrobe and asking where the fuck the coffee is. Private credit, or everybody has agreed not to look. Private credit's the same story, wearing loafers. A loan that once might have sat on a bank balance sheet can move into a fund. It can pass through affiliated entities. It can land within an insurer or a pension or be valued by a model because nobody is eager to discover what it would fetch at an actual market price. Public markets are fucking vulgar. They ask what an asset is actually worth. Private markets are civilized. They don't do any of that. Everybody meets quarterly. They agree that the loan is worth approximately what everybody agrees that would prevent the meeting from becoming unpleasant. They want to ensure that everybody is happy. They want to ensure that there is scotch. They want to ensure that nothing goes wrong. If the borrower struggles, the lender just amends the loan. Sometimes the amendment will add payment in kind interest. That will increase the claim while reducing the amount of cash that the borrower must produce today. The larger claim improves the spreadsheet while the borrower becomes less able to pay it. And this is called a workout. A public bond falls 20 points in these environments. But in the world of private credit, you get to meet a guy like Pierce. Pierce, he will send you a memorandum. Okay, this guy went to Duke. He uses the phrase constructive engagement. He describes a loan that has been dead for 6 months as performing through a transitional period. Nothing has happened until Pierce says it happened. And then investors request redemptions. The marketing deck may have said quarterly liquidity, but you know what? The legal documents said the manager may suspend, defer, prorate, gate, limit, postpone, spiritually reinterpret corporate liquidity until conditions that the manager considers appropriate. The investor read the marketing deck. Pierce reads the legal documents. Pierce wins. He did a dual program, Duke Law School and Fuqua Business School. He goes to every Duke UNC game. He donates money to the school. He's a big deal, right? And people will look at this and they'll say, hey, there's a door, right? But the reality is, please stop calling all of this liquidity. Liquidity is the ability to actually leave. This is a picture of a door painted on a wall. It has a green exit sign and a very tasteful photograph of a pensioner walking through it. Then the building catches fire, and the investor grabs the handle and discovers the handle was just a graphic design element. The manager explains that withdrawals have been prorated to protect remaining investors. And protect them from what? The price? The one piece of information the structure was designed not to actually produce. Private credit does not abolish volatility. It delays that appointment. It sedates the number. It places it in a quiet room and tells the investment committee the patient is resting comfortably. Then cash is requesting. Hey, cash is vulgar, everybody. Cash wants an answer. The door was real until somebody tried to leave. The reality, though, is that all of this is circular inside of insurance. And if we really dig deeper into how all of this is working, we really understand this. Here's how private credit really works. The model becomes even more circular inside insurance. Okay. Insurance collects premiums. The affiliated asset manager directs more of that money into private loans. So smooth marks allow larger allocations. Larger allocations create more fees. Those fees and the growing asset base help the manager acquire, seed, or partner with more insurance capacity, which sends more money back to the same private credit machine. Guys like Pierce. Okay? So, that is not vertical integration. That is a snake discovering tax efficiency. And then the building catches fire, and Pierce stands in the foyer explaining that the smoke is performing through a transitional period. The ceiling collapses, and Pierce calls it localized overhead repricing. And an investor asks whether there's another exit, and Pierce says exits remain available subject to capacity. The investor then points at the fire, and then Pierce asks whether he reviewed the side letter. And the pension trustee begins hitting the painted door with a chair. And Pierce says aggressive redemption behavior may disadvantage remaining stakeholders. And then the sprinkler turns on, and it contains a revised valuation memorandum. And the building remains 98% occupied. Technically true. Nobody can leave. The investor committee asks whether the fire requires a markdown. And Pierce says the fire isn't observable from any ordinarily transaction, and the building remains at par. This is not a liquidity problem. It's a language problem with flames, everybody. And the language is winning. The firm survives the fire so long as the fire never becomes a transaction. The building can burn the fuck down. Pierce cannot lose the meeting. For God's sake, Pierce cannot lose the meeting. You don't extinguish the loss. You keep it from clearing. The Cantillon and flow, which is the whole point of all of this, is that the plumbing determines who receives liquidity first at all. Liquidity doesn't support falling evenly across the entire world of finance. And this is the whole point of the world we operate in. Where does money even start from? Where does it even go? Who gets it first? We can't allow money to go downstream. We have to make sure it stays here. We have to make sure that it stays here right now because we have to ensure that we can meet those pension obligations and they're able to ensure that they're able to get the income that they need. So we can't let middle class people redeem on these elaborate semi-liquid ETFs and private credit. Are you out of your mind? No. When new money is formed, you've got to protect it. You got to keep as much as you possibly can up at the front of the supply chain. And then when it has served its purpose, then you allow it downstream. Money moves through banks, dealers, and asset markets and large borrowers before it reaches a person who mainly notices that groceries, insurance, and brake fluid all cost a shitload more now. The people who are nearest to the source can buy things before prices adjust. The people farthest from it receive those adjusted prices. That's how market plumbing actually becomes politics. So the backstop supports the dealers. Here's your central bank activity. Here's your actions by what's upstream. Sometimes the Treasury Department is involved. Hey, whatever needs to be done. Okay, the dealers support the trade. The trade supports the Treasury market. The Treasury market then supports the federal financing. That liquidity can support collateral and asset prices. You're moving this way. You're not going from here to here. Are you out of your mind? You're going to give Americans money? Do you know what they're going to do with it? They're going to go directly to the stock market and buy the ARK Innovation Fund. They're going to buy Bitcoin. We've done this already. We did it during COVID. You can't trust these people. You can't give these people direct access to money. They're going to take it and they're going to go out and they're going to go immediately buy baseball cards. They're going to buy so many baseball cards. They're going to buy baseball cards. If you give them direct money, they're going to go out and they're going to buy baseball cards. And they don't need baseball cards. Do they need baseball cards? No, they don't need baseball cards. Don't let them take their money and buy baseball cards. Or they're going to go to DraftKings. They're going to go to DraftKings. They're definitely going to go to DraftKings. And they're going to bet that money. Well, it's a good thing that all of these gambling sites and all of these other things are now controlled by private equity, because now if we do provide money directly to the households, we can ensure that everything that they do spend money on trickles right back into the private equity stream. So that's taken care of, right? So if you need, I don't know, somebody to come over and kill the ants on your property, they won't just kill the ants one time for you. You have to sign a service contract that will ensure that they can keep coming back time and time and time and time and time and time again for $150 a month. And then that cash flow can be securitized for the private equity company that owns Aptiv, and then that can be sold to an insurance company. So we have plugged up the Cantillon effect in some ways. So even if we do print money directly, we can ensure that that household money can come back to the private equity side if we need to. But for now, let's just focus on how money really does operate. The liquidity will support collateral and asset prices. The benefits arrive through the balance sheets. The bill arrives through living costs. And that's how you end up meeting a woman like Doris. She taught 8th grade. She taught math for 36 years, everybody. She bought her house decades ago, and it paid off, and she doesn't know what sponsored repo clearing means. She doesn't need to, because all she really knows is that her property tax bill went up. She knows her insurance went up. She knows the grocery bill rose faster than her check. She knows that the math no longer works. That's the transfer mechanism. Not because a central banker mailed Ken Griffin a check and then mailed Doris an invoice. The chain is more indirect, more defensible, and therefore it's more durable, right? It's not a situation where money goes directly through direct stimulus and then spills back and trickles back up. No. It's not even trickle down economics. It's a gradual supply chain of money where certain people win, certain people lose, and then certain people really get screwed because the only way they can actually access new capital is by putting it on a credit card. Okay? So again, as I said, liquidity can support collateral. It can support asset prices. Asset gains expand the purchasing power of the people who already own the assets. And that wealth then competes for scarce housing, land, services, and insurance capacity. It isn't the only force that raises Doris's bills, though. But Doris still receives the downstream number with an acronym that never appears on the envelope. And meanwhile, in the actual fucking country where people live, families check the bank balance before entering their grocery stores. Dental work waits, insurance renewals arrive like ransom notes. Foreclosure failings are rising year over year, and the national foreclosure start rate has moved back to roughly the 2019 pace. Florida sellers have cut prices. They've cut prices with the real estate influencer films a video titled Why Southwest Florida is About to Explode. Listen, Kevin, I lived there. It already exploded. It's why a lanai is currently sitting in the neighbor's swimming pool, okay? So this is what is happening in this economy right now. And this is where we are, and this is where we're going to wrap this up. The savings rate in America is hovering around 3%. The top of the economy is borrowing hundreds of billions of dollars to build data centers, and we're all being told this is a generational opportunity to buy AI data center stocks. The bottom of the economy, households are using installment payments for gas and groceries. Financial television keeps the S&P 500 in the corner of the screen as proof that everything is fine. And the stock market is not the economy. I have to stress this for the 800th time. It is a scoreboard for claims on the most profitable portions of the economy. It isn't moral. It doesn't know you. The index is not going to attend any of our funerals. Doug may send flowers because he still manages the estate. One boring trade nobody in a quarter zip up will shut up about long enough to notice is that AI may change the world. We know that. That does not mean every company financing it is going to earn a good return. And I remind you, the internet changed the world. Many internet companies completely blew up. Railroads, they changed the world. Most railroad investors lost fortunes. A technology can transform civilization while its capital structure catches fire in a drainage ditch. Okay? A large technology firm that has been praised in the past for being asset light. It didn't work out for some places. Software, networks, intellectual property. Now they're becoming railroads. They're becoming land. They're becoming concrete. They're becoming transformers, cooling systems, transmission lines, power contracts, things with debt. A market spent 20 years valuing them as weightless clouds. And then the clouds picked up and said, you know what we really need right now? We need a nuclear reactor. And eventually, Silicon Valley has to attend a county planning meeting. And the company arrives prepared to build artificial superintelligence. It has $1 trillion market capitalization, a frontier model, and a chief futurist who's written a book about transcending biological limitations. And across the table sitting in a folding chair, is Carol from zoning. And Carol is holding a ruler. And Carol does not own NVIDIA stock. The chief futurist will tell her that the facility may unlock abundance for humanity. And Carol wants to know whether the backup generators will comply with the nighttime noise ordinance in this town. He will say that the model may accelerate drug discovery. And she says the setback is still 35 feet. The company attorney will invoke national competitiveness. And she will ask whether the drainage plan has been stamped. And it hasn't. Civilization has reached the final bottleneck. It's Carol. The board approved the capital. The bond market supplied the debt. The chip company allocated the transformers. The governor issued a press release about the future, and Carol needs fucking wetland delineation in blue ink. The CEO calls Washington. Washington calls the governor. The county executive gets called. He calls Carol. Carol's at lunch. She returns at 1 o'clock. And the setback stays at 35 feet. That is the physical economy. The cloud can't threaten to replace human cognition. The cloud can't pour concrete until Carol signs page 4. AI runs on electricity. The model is digital. The power plant is not. The transformer weighs hundreds of tons and has to deliver a schedule longer than most political careers can. The expensive model needs power. The model needs cheap power if possible. The cheapest model needs the cheapest power. And the open source model built by a 19-year-old drinking Arctic Vengeance needs power too, because everything plugs into the wall at once. The person who owns the wall gets paid. So my message to you, after all of this bullshit, is own the wall. Own the turbine, own the transformer, own the nuclear plant, own the physical thing every version of the future requires. And Smithy might never mention this. The orthodontist may never hear about it. And that may be the opportunity, because here's where we are. The AI trade is being sold right now. It's being sold right now back to investors by the same research complex describing the degrossing of these markets. Sell-side notes will manufacture chains of custody for blame, leverage products, buy because prices rise, and sell because prices fall. The Fed wants discipline until discipline threatens the financial system. Japan is reconsidering the role of the cheap yen. Hedge funds supply Treasury demand through leverage, regulators fear. Clearing concentrates risk inside institutions that can't fail. Stable coins are escape for government money and an end buyer of another government bill. Private credit offers liquidity until somebody actually asks for that fucking money. That machine is not fake. It's real, productive, profitable, and structurally dependent on support. But on top of this, recognize that the one constant, the one thing we need, and we need a lot of it, is power. We're going to need a lot of power. And remember, the institution can't lose the meeting. So a lot of this is all still in focus. The thing I want to remind you about all this is that at the end of the day, what we are looking at with all of these projections and all these calls, I'm asking you to stop accepting the language, okay? That's the call. Stop letting an institution rename an event until the event becomes respectable. A bailout routed through a dealer is still a fucking bailout. A run delayed by a gate is still a run. A loss hidden by a model is still a loss. A forced sale generated by a formula is still a forced sale. A market whose most important prices can't be permitted to clear is not a free market just because the app has confetti on it. A building isn't robust because the fire department moved into the lobby. Don't call any of this a conspiracy. This is stronger than a conspiracy. It's an incentive structure with legal counsel. Nobody needs to coordinate the outcome because everybody understands the outcomes are important. We know which outcomes are actually professionally survivable. The bank needs distribution. The fund needs financing. The regulator needs continuity. The politician needs the index upright. The Fed needs stock prices higher. The central bank needs the Treasury market functioning properly. The analyst needs the narrative alive. The clearinghouse, they need the bomb at the quarterly workshop. That guy Brock needs the revolution at the valet. Pierce needs the fire to remain non-observable. Doug needs the second boat, classified as a long-duration lifestyle asset. This is all about preserving the machine, not really asset prices. Professional continuity. We are all in this. We're all part of this ecosystem. We're all holding on to Ken Griffin's helicopter saying, God damn it, give them money. Make sure that they are passing liquidity through the cycle and one of us gets to gut up and keep doing this insanity every single day. The right of every institution to arrive tomorrow with the same authority it had before today's failure. The client can lose money. The homeowner can lose purchasing power. The worker, once again, that worker can lose their shift and the public can lose faith in everything, but none of these institutions can ever lose the meeting. Okay? I'm not screaming about all of this because the system's fake. I'm screaming because it's real. I understand how it works. And Greg at the pool has stopped answering my texts. Okay? If I don't scream all of this into the abyss, I'm going to scream it at the Padonia pool. And that's not going to end well for anybody. I need to stop talking about this. So for 2.5 hours on a Friday night, I locked myself in my office and I just talked. Okay? And the impolite questions have to be asked. Okay? This is how we're going to wrap this up. Who gets the cash first? Which price was prevented from clearing? Whose collateral was protected? Which private balance sheet survived because the public balance sheet moved? And what dependency has been created for the next rescue? We're going to talk about these things in the future. So I will remind you every time, the Federal Reserve's balance sheet is a confession, but the key thing to always keep in mind, read the pipe and follow the collateral. Find the marginal buyer in all of this. Then ask, who owns the toll booth? 40 years from now, some economist who has never held a job outside of a university endowment will win a major prize for pointing out that the system that we are operating in is not capitalism. The paper will be 83 pages, and it will be called something really stupid like endogenous intermediation capacity under continuous conditions of southern collateral scarcity. And everybody will applaud him. And then by then, the plumbing will have been rewired 3 more fucking times, and hedge funds will have been renamed with a Greek letter, and Larry Fink's consciousness will be stored in a Delaware trust and licensed back to humanity for 75 basis points a year. Smitherson will still be on television in slightly different vests telling somebody's grandkids that this is the buying opportunity of a generation. The next time a man in a $4,000 vest looks into a camera with tears in his eyes and tells you to buy the dip, make sure your wallet is still in your pants. Check whether his client's already sold. Somebody still needs to buy. Somebody still needs you to buy. That's the show. Watch what institutions do, okay? Not what they say. The speech is all marketing. The balance sheet is a confession by the central bank. Own the boring physical thing every version of the future requires. Keep some cash. The pipes will be rewired again, and one of them is going to burst, and the people who told you cash was trash will appear on television holding cash. And remember, Doug is going to call. He's going to call and he's going to say, listen, bud, we're seeing some volatility. You will hear seagulls. Doug is on a boat. Good night, everybody. Tip your wage staff. Turn off your notifications. Give your dog a treat. Go read Glenn Handley. And if Doug asks for money to buy a second boat, tell him to rebalance the first one. Stay positive, everybody.